Leasing, a new standard is finally here, was a live webinar that was originally produced on Thursday, April 25th, 2019. For this webinar, we were joined by Dan Sturm, Brett Bauer, and Tim Showers with McConley and Asbury. We hope you enjoy this recap, and please visit us online at macpas.com for more information about our future webinars and other events.
Welcome to the webinar. Leasing, a new standard is finally here. I emphasize the word finally, and we'll get into that in a couple minutes here. But finally, because this has been years in the making. I'm Dan Sturm. I'm a partner with McConley and Asbury. Also with me today is Brett Bauer, Senior Manager, and Tim Showers, Supervisor. Our objectives of the course today, we want to talk about how the new standard differs from how you've been accounting for leases all these years prior. We want to show you some illustrative financial statements, which will show you exactly how the changes and what they look like in the financial statements. And we want to help you gain an understanding of what you should be doing to prepare over the next few months. First thing is why the new standard? Well, as I've mentioned a couple times already, this has been a long time in the making. This started about 10 years ago. The first reference to this came out. Discussion started taking place. So it's been many years in the coming, and it's been basically since my tenure at McConley and Asbury. So I remember starting this conversation with clients at board meetings, again, several years ago. It came to be because FASB noted there was over $1 trillion of off-balance sheet leases. So a lot of these items were disclosed, but as we'll talk about in a little while as well, these disclosures don't get the same attention typically that information on the face of financial statements get. Basically that came to be because there were so many leases, known as operating leases, structured and specifically written in a way to keep them off the balance sheet. It was a desire in most cases with most companies that they prefer to keep those liabilities off the balance sheet. So many vendors and service providers were well aware of the standard as it was written, to write them and put parameters in the agreements to keep them off the balance sheet and require disclosure only. Part of that, under the new standard, what is a lease? So we could probably spend a whole presentation just talking about what is a lease. A couple of things to keep in mind as we go through this and understanding the new standard. A lease requires both an identified asset and a right to control that asset over a period of time. So I think that's pretty self-explanatory, but these are a couple of key points as we work through the presentation. I think similar to in today's environment, most leases should be straightforward. But I think what I expect and what we've talked about is just like under the old standard, there is a desire, and that desire continues to keep leases off the balance sheet. So what I expect to see, I haven't seen it yet, but what I expect to see is agreements written in ways that could still potentially try to keep things off the balance sheet. So I encourage those on the call to be aware of those items as well. So while the top of the agreement may not say the word lease, under the new guidance and new definition, you very well could have a lease that falls under the new standard. As we've talked about, and I think, again, this has been such a long time in the coming, I think most people on the call are aware, or webinar at this point, are aware that the biggest change in simplest terms is leases are moving from, a lot of operating leases are moving from disclosure to balance sheet presentation. So that is by far the biggest change. So while there's a lot that comes along with the new standard, this is the biggest change. So that balance sheet presentation, liability and asset for all leases essentially at this point. Lease assets and liabilities will be recognized for all leases over 12 months. So if you have something less than 12 months, we'll get into that in a couple of our examples. Obviously, you don't need to apply this guidance, but anything else, any lease agreement will fall under this guidance, and you will now have an asset and a liability, very similar to how you account for capital leases now. And as we pointed out here, current GAAP only requires capital leases to be on the balance sheet, so this puts all leases on the balance sheet. The new guidance also provides a lot more information on lease identification, as I talked about a couple minutes ago. Just because the agreement doesn't say lease at the top doesn't mean it's not a lease. So there's going to be a lot of information on specifically identifying when you have a lease and when the new standard applies. Income statement expense recognition, and this is the conversation I've had with my clients. I don't see a big bottom line impact. So what I do expect to see is maybe some movement on the income statement of how things are classified, but I don't see a tremendous impact on the bottom line on your income statement. We do retain a distinction between finance and operating. Finance essentially is what you have for capital leases, so that's probably an important distinction. So again, while not a big impact on the bottom line, you still have those two distinctions, and we'll get into a few examples of what those distinctions might look like. Finance leases, similar to capital leases now, you're going to have some interest expense and amortization expense. Operating leases, you're going to have a single lease cost, so you lose that interest expense. Again, if you put them together, probably very similar bottom line impact. As far as determining when do you have operating versus finance, consider using the old guidance as your stepping stone. I think that's a great place to start.
Yeah, so Dan, you mentioned that current guidance will serve as a good starting point when making this distinction between leases and how they fall into those two buckets of operating versus finance. Is that determination criteria substantially the same as under the old guidance, or are there some differences that are entailed in the new guidance as well?
I think it's mostly the same. So I would say, to answer your question directly, it is substantially the same. The only thing I would add to that is under the new standard, if you have some very specialized or unique asset that's being considered, that also falls into that bucket. So as soon as you have something you consider so unique and specialized that the leaseor would have no use to have it back and they can't sell it to another customer, that would fall into the finance category. Another important change under the new standard is segregating lease and non-lease components. I'd like to point out in the first bullet, there is an option that you can elect to have a policy not to separate the lease and non-lease components by asset class, but that would result in additional liabilities, obviously. Some things that are common in leases we see: maintenance, you might have some repair services, cleaning. What I would also point out in the last bullet, property taxes and insurance are not considered non-lease components. They are part of the lease liability. Other things to be aware of, and again, we have about an hour to present a pretty technical topic, but things we want to point out and make sure you're aware of, to take note of if you do see them in your leases that will change how you calculate your lease liabilities and assets. Variable lease payments, so if you're going through your agreements and you see payments changing, just be aware that there might be a different way to account for those. Next is renewal options. The minute you see language for renewal options, we see this a lot in real estate leases. Make sure you're aware that there is guidance associated with that, and we'll get into that with a couple of the examples we have. And last, I think this is the biggest impact, debt covenants. So to the extent you have any debt covenants that are centered around your balance sheet, please note that we do have, depending on the type of business that you're in, you're going to have a lot of new liabilities on the balance sheet related to the leases that you're putting on your balance sheet. With that, we do have our first polling question. What type of impact do you expect the new leasing standard to have on your financial statements? Answer A, significant. Answer B, moderate. C, minimal or no impact. And D, you're unsure. And we'll give you about a minute to answer this question. I'd also like to point out with the polling questions, please make sure you answer that, because we will be tracking the responses for CPE purposes as well. Looks like we do have some results coming in.
Yeah, this is one of our questions that I'm most curious and interested to see where the results fall, Dan. Just with, we've heard about the leasing standard for the last few years now, and now for private companies, it's really starting to come into view on the horizon. So I'm just curious to see what the perception is and what the expectations are in terms of how this is going to play out on the financial statements of individual companies.
No, I would agree. It's here. It's so I think a few years ago we might have thought it might not get here, but it's here. It's not going away at this point.
Right. So the results are in from that, and it looks like the leading response is that most people in our audience today expect a moderate impact, at 42%. Minimal or no impact came in at second, with about a third of the audience expecting that. Unsure came in third place. Have some people that are still feeling out the new standard and just developing an expectation. And if that's where you're at the right place this afternoon, because that's really what we want to do. We want to set the scene for everybody and really give some guidance and some important considerations for as you seek to begin your implementation plan. And then coming in last with significant impact, about 8% of our audience foresees a significant impact on the financial statements.
I would say those results are a little bit surprising to me. I expected to see more individuals identifying this as having a significant impact. This morning I was running through some real client examples just to get an understanding of what the impact would be on their financials, and I found two of my clients, the impact is probably about $5 million on their balance sheet, which makes up about 10 to 20% of their liabilities. But another one of my clients who leases a lot of property across the country, so those are longer term leases for a higher dollar amount, they're looking at their liabilities increasing from about $3 million to $15 million. So that's a multiple of 5 on their balance sheet as a result of this standard. So it might have a more significant impact than you realize.
No, that's a great point, Brett. This standard seems to, this can definitely surprise you and exceed your expectations in terms of having a larger impact than perhaps what you might expect. All right, so to dive into that subject of financial statement impact, just to kind of summarize what Dan was just walking through and give a high-level view of what to expect in terms of pure changes in the numbers that you would see on your financial statements. General observation for us, based on our review of the standard itself, as well as some of the companies that have early adopted, so just to see this in action, is that the changes resulting from the new leasing standard will primarily impact your balance sheet and then also your footnotes via some additional disclosure requirements that are entailed in the new standard. So you can really see that in the chart. Just going down for operating leases, that's really where the big significant changes are going to play out. With those operating leases now coming onto the balance sheet, they're going to increase the total assets for companies as well as the total liabilities. Once we get down into net income, we could see some minor changes from company to company, mostly resulting from changes in the timing of when the expenses might be recognized. So see some minimal impact there, particularly with respect to operating leases and how those are accounted for. And then, of course, once we get down to the cash flow, just from the standard, of course, is not going to impact the timing of when you're actually making the payments on your leases. So no impact there. So balance sheet specifically is where we'll hone in and really emphasize those changes and point those out, as well as the footnotes as well. Also, just to give a high-level overview of what to expect in terms of presentation impact, we looked at the numbers and what would happen with the numbers themselves, but also just to lay out for you how this is going to end up looking on your financial statements. So in terms of balance sheet, for finance leases, similar to what were referred to capital leases under the old standard, we're going to still have the asset recognized related to that leased piece of equipment or machinery or what have you, and again have a corresponding lease liability. Same with operating leases. We're going to have those right of use assets coming onto the balance sheet being added, as well as the liability being measured and corresponding with those. Income statement is where we start to have some changes in classification between the two types of leases. On the finance side, similar to capital capital leases, we're going to have that interest expense that corresponds with the reduction of the liability as you make those payments throughout the course of the lease term. And then on the other side of things, you'll have an amortization expense as well, which refers to the amortization of the asset that you're leasing. On the operating lease side of things, will look a little differently. The recognition of the expense related to those is going to be recognized as one expense. It's going to be recognized as a lease expense. So you'll have one type of expense on the income statement, and that lease expense will be in virtually all cases is going to continue to be categorized how you would have recorded your rent expense under operating expenses or operating leases under the old guidance. We also see some impact on the statement of cash flows in terms of differences in how cash flows will be presented on the statement of cash flows. So finance leases, your cash flows are going to impact two segments of the statement of cash flows. You'll have the interest portion of the liability that you pay throughout the lease term categorized in the section for operating activities. And then the principal portion of the liability, those payments that are specifically related to those will be a financing activity. And then on the operating lease side of things, that lease expense, the entirety of that payment is going to go into operating activities and be disclosed as such. And again, as mentioned earlier, another change really is going to hit the footnotes in terms of just more extensive disclosures that will be good to prepare for as we approach the effective date of the standard.
Tim, I think this that slide gives a really good picture of back to debt covenants, and I will talk about that later as well, but I think it paints a really good picture of how your covenants are going to be affected, because obviously those of us in this room, we've seen debt covenants worded in many different ways. Some subtract out interest expense or amortization. Again, I think it just gives a very high-level summary of, if you're familiar with your debt covenants, just seeing the impact on those covenants from these changes.
So as companies begin to prepare to transition to the new guidance, of course, as Dan mentioned, the debt covenant considerations certainly should be a top of mind. And other considerations as you go to implement this from an accounting standpoint, certain things that are very important to know is that for private companies, there are some practical expedients that are at your disposal that you can elect. And what these are designed to do is to make it a little easier to come under the new guidance. A couple of those practical expedients that we wanted to highlight for you today. One is the option to not reassess the classification of existing leases. So as you transition to this new guidance, one of the things that would certainly save time is that if you have leases that pre-exist the new guidance when you're going to have to go in and adopt, you don't have to go back and under the new guidance and say, well, I consider this to be an operating lease under the old guidance. Do I still believe that to be the case? So in other words, if you've gone through and made that determination for leases that pre-existed, the transition dates that you can see on the slide, you do not have to go back retrospectively and reassess. So an operating lease under the old guidance, you'll continue to consider that to be an operating lease under the new guidance. Similarly, capital lease that pre-existed the transition dates that are on the screen, you can make the assumption that that's going to be a finance lease. So that's certainly a good practical expedient to keep in mind, because just from the time savings that could result in for you and your team. Another option that we think is worth consideration from the standpoint of practical expedience is the option to use a risk-free rate instead of the incremental borrowing rate when you go to determine your lease liabilities. So under the guidance, the new guidance at face level, what companies are required to do when you're going in and going about measuring the liability that's associated with your lease is to determine or estimate your incremental borrowing rate. And what that is the interest rate that a company would be charged to borrow the funds on a collateralized basis over a similar term to what the lease is. Understanding that could take some time to estimate and just result in an additional burden placed on accounting teams, and perhaps have information that you might not readily have available. What's been made available by the FASB is the option for private companies to use a risk-free rate. So in other words, a company could make the election to take a look at what the rate is on government securities, so treasury bonds, treasury notes, over a term that is similar to what your lease term is, and use that rate instead, which would save the time of actually going in and estimating that if that's not something that is readily available. So certainly that's something on the positive side. On the negative side of that, to keep in mind, this is an all or nothing election. So this would be an accounting policy election that you would make and would have to consistently apply across all your leases. So you couldn't use risk-free rate for one lease versus incremental borrowing rate for other leases. And the other potential negative would be the risk-free rate tends to be lower than the incremental borrowing rate. So with a lower interest rate, your liability that would result from that calculation would be higher as well. So certainly positives and negatives to that, but we did just want to present that for consideration. Key date to keep in mind as you think about making the transition to this new guidance is, if you're a private company, January 1st, 2019 is going to be such a key date for you when it comes to the initial measurement of your leases. January 1st, 2019. The reason we say that is when you think through things and how this adoption is going to go. If you're so effective date, with that being January 1st, 2020, when a private company goes to prepare its financial statements for the 2020 year, in order to make things comparative and ensure that consistency from 2019 that's going to be presented along with the 2020 statements, you're going to need to go back and recast your financial statements to what they would have been under the new guidance. So just keep that date in mind as a key date, and we'll point out some particulars about that here. And I think that's really going to be highlighted in this example. So one of the things that we really wanted to do today is walk through an example of a lease that just to show how this will play out in terms of the accounting and the entries that will be needed to make the transition to the new guidance. So in our example, this company has an existing lease for office space that they use. So very common type of lease. Many companies have these types of leases. So I believe very relevant. So in our example, the lease commencement date. So this lease term began on January 1st, 2018. So it pre-exists the transition date. We have a lease term of 5 years. And we also have some escalating payments involved in this lease in our example. So payments in years 1 and 2 of $31,000 per year, and then years 3 through 5 of $33,000 per year. As a result of those escalating payments and just the straight line expense that was required under the previous guidance, the company also has a deferred rent liability on its books, resulting from that accounting treatment that will have to be dealt with to make the transition. And then in our example, the company does use the incremental borrowing rate as a 1/119, which in their case is 6%, which is what they'll use to estimate their liability. So that's what's going to be used in our example, which is certainly perfectly fine for the company to have done. We would just again reiterate that what they could have used the risk-free rate as a 1/119 is a perfectly acceptable election if they had decided to go that route. In which case 2.51% would have been used based on the 5-year Treasury note rate that existed as of 1/119, which is the transition date.
I think this is a great example, Tim. I think this is a scenario we see in almost every one of our engagements with these rental leases for space. So I think it's a great example to start with.
yeah, definitely a common and very widespread type of lease. And the one thing that I would point out for consideration here that we definitely want to emphasize is while the lease commenced on 1/1/18, 1/1/19 is the key date for taking a look at balances and what was the incremental borrowing rate as of that date, because that is the key. There is it's the beginning of the earliest presented year in the comparative financial statements. So don't let that trip you up when you go to begin to implement this. All right, so here's what it'll look like based on that set of factors for this lease. So when the company goes to recast its 2019 statements to make a comparative, the process is going to start with this journal entry that you see on the screen. And it's going to serve two purposes. The one is under the new guidance, because we have to, for an operating lease, we have to now recognize a right of use asset and a related liability. Under the new guidance, that's what it's doing. And then the second purpose of this entry is to remove that deferred rent liability balance from the balance sheet. So entailed in this new guidance is, whereas under the previous guidance, we would often have for escalating payments, these deferred rent liabilities or assets, that's no longer going to be the case under the new guidance. So that's part of your initial entries is going to be removing any of those types of liabilities or assets from the books. So that's exactly what you see happening there. So we're going to, in terms of the entry then, to reflect what existed as of the beginning of the earliest comparative year, we'll be debiting the right of use asset. We're going to be also debiting the deferred rent liability to take that off the books, and then we'll credit the lease liability to bring that onto the balance sheet as well. And also on the screen there, you see how those various amounts are determined in the entry. So that was our previous slide showed our initial entry. Of course, then we're going to have to make an entry to reflect the activity that occurred during our comparative year of presentation. So you'll see the entry on the slide there that captures that activity for the year. And then we've also included the chart right just below it, just to illustrate the movement that's going on behind the scenes there, that's also ultimately rolling up into that entry, that catch-all entry that you see reflected there. So under the terms of our example, we see that the lease liability reduced by $24,252 as the company made those payments that were scheduled during 2019. We also see a lease expense being recognized and brought onto the income statement on a straight line basis of $32,200. As you can see from the underlying detail that's in the chart there, that lease expense is expressed as one type of expense. It's on the income statement. However, underlying that is two different components. So we have the interest expense portion of that of $67.48 that pertains to the paying down of the liability. And then you also have the amortization of the right of use asset of $25,452. So those two components that are underlying that are coming together, and that's expressed as one type of expense, lease expense, on the income statement. And then, of course, we are amortizing the asset, so the asset gets reduced over time in 2019. And then lastly, of course, the cash went out the door of $31,000 in accordance with the terms of the lease. So we're reducing our cash balance for the year.
I think it's important to highlight, Tim, as well. You made this point earlier. Despite this is all accounting, so it's not changing the cash going out the door. And we've made this point with the revenue standard as well. So while there's a lot of new terminology, new journal entries, new presentation, cash going out the door is the same. So it's not changing that. It's changing presentation, disclosure, and some journal entries. Just want to highlight that.
Yep, absolutely.
And Tim, I have a question for you. So if I implement this standard, and as of January 1st, 2020, I have 6 months left on a 5-year lease, do I still have to put that remainder of the lease on the balance sheet, even though there's less than 12 months remaining on the lease?
Yeah, that's a great question, Brett. Yeah, I think that there will be a lot of situations that'll be the common with the nature of ongoing leases, and as companies go to implement it. So, in a situation like you just described, when you have a lease that only has 6 months left on it as of 1/1/20, we have that in the guidance that. We know that for leases of less than 12 months, those don't have to come on the balance sheet. So it might be, given that set of circumstances, it might be tempting to think that, oh, less than 12 months remaining, I'm making the transition, I don't have to put this lease on the balance sheet. Under the requirements of the guidance, you will have to. You will have to put that on the balance sheet. And the reason for that is the guidance specifies that you have to consider the initial term of the lease. So because under your example, Brett, that initial lease term was 5 years, that's what we have to consider when we're deciding what leases have to come on the balance sheet. So it's that initial term rather than whatever happens to be remaining on the balance sheet as of the date that we're making this implementation to the new guidance. Another important consideration is going to be exactly how, given the entries, those types of entries that we just walked through, exactly how those are going to play out and what the guidance would require in terms of balance sheet presentation, in terms of how those are reported on a company's financial statements. The codification itself sets some specific guidelines for companies, and those guidelines for balance sheet presentation are as follows. Companies under the guidance are required to present the following on the balance sheet or in the footnotes. So first of all, you have finance lease right-of-use assets and operating lease right-of-use assets. These must be presented separately from each other and from other assets that a company might own. Similarly, for finance lease liabilities and operating lease liabilities, those also must be presented separately. So the guidance is setting an important distinction here in that it's requiring that, and it's precluding companies from lumping right-of-use assets that might be resulting from operating or finance leases. It's precluding companies from lumping those together. Those are considered to be two distinct types of assets, two distinct types of liabilities, and as a result, the specific requirement has been set to present those separately on the balance sheet from each other, and present those separately from each other in the footnotes as well. Lease liabilities that are resulting from operating and finance leases, they're under the requirements, those should be broken out between their current and non-current portions. So similar to any other type of liability, or similar to what you would do for a note payable, if you'll have certain payments, certain liabilities that are resulting from payments that are due within a year of the balance sheet. So those liabilities from those lease payments that are due within a year, you should report those as current, and then the rest as non-current. And then additional consideration for your right-of-use assets that are resulting from the leases. Most of those, in virtually all cases, will be classified as non-current. So similar to what would occur from your traditional property, plant, and equipment that the company owns and is paying for outright. So in virtually all cases, those will be classified as non-current. So given those requirements, this is what you can expect to see, this type of situation on the balance sheet then under the new guidance. So you can see in this example, this company has some operating lease right-of-use assets. So they have gone on their balance sheet and they have appropriately presented those separately from their finance lease right-of-use assets. And in this particular example, the right-of-use assets resulting from finance leases are included within the property and plant and equipment line items. So this company has taken the requirements and applied them similar to what they would have done for their capital leases under the old guidance, and in a lot of cases where those capital leases will be put right in with property and equipment.
That looks a little strange to me, Tim, to see operating lease right-of-use assets broken out separately, but the financing assets are within property and equipment. I'm wondering, do you think people will actually present it that way? And if so, what would be a benefit of doing that?
Yeah, that's a good question, Brett. I think that in this particular case, it really is a reflection of the flexibility that the codification and it offers with how the requirements are set out. So the underlying requirement is that you just can't present them together. So they have to be presented separately from each other. And then all somewhere either on the balance sheet or in the footnotes, the actual specific amount of the asset and liability needs to be disclosed as well. So I would say that there are certainly benefits to disclosing them individually on the face of the balance sheet. It certainly makes it more straightforward to have them just presented outright on their own. However, in this, as we can see in this example, just from a consistency standpoint, this company has determined that, well, we presented our capital lease assets under property, plant, and equipment in the past, so we are going to continue, for consistency purposes, to continue to group those in with the rest of our property and equipment. So both approaches are equally correct in accordance, and they meet the requirements of the guidance. It's just a matter, it really does, in this case, given the judgment and the flexibility that the guidance offers, it's a matter of preference when it comes to what management is looking to do and what will best meet their needs and the needs of the financial statement users. So here's an example of what then you can expect on the liability side of things. In this case, in accordance with the guidance, the company is again appropriately distinguished and separated the line items into which they are classifying and recording their operating lease versus finance liabilities. In this case, they've presented them outright on their own, assigned their own line items on the financial statements. There's certainly advantageous from the straightforward appeal of that. And then similar to other liabilities, they've appropriately classified and differentiated between the current portion and the non-current portion of those respective liabilities that are resulting. So in addition to the impact on the face of the financial statements that we just walked through, there are some qualitative disclosures that are required then that a company must include in the footnotes as well. So not only do we see an impact on the face of the financial statements resulting from the standard, but also in the footnotes as well. So you'll see there are numerous qualitative disclosures, but three in particular that we wanted to highlight that pertain to the standard would be: company must include a general description of the significant ongoing lease arrangements they have. The company must also point out any provisions to extend or terminate the leases that are existing within the agreements, and including how those are reflected within the lease assets and liabilities that are recognized on the balance sheet. So again, just that, and with the acknowledgement that there is some judgment involved, as we just looked at, in terms of how these assets and liabilities are going to be quantified. That's why this disclosure requirement comes into play in terms of being able to speak to the determination or extension provisions and whether or not those are used in estimating those. And then any restrictions or covenants imposed by the lease agreement should also be disclosed in the financial statements as well. A few other qualitative disclosures that we wanted to point out: a company should disclose information about significant leases that commenced after the balance sheet date, just to be able to speak to any type of significant subsequent event that would impact leases. And then going hand in hand with what we just discussed on the last slide, significant assumptions and judgments that were made in measuring the lease liabilities and lease assets, including discount rate that was used, and then also how it was determined that indeed that contract was a lease. Right. We've included in the slide then just an example of what you might might include on your financial statements that captures those qualitative disclosures. This, along with our entire slide deck from the presentation, is available. So feel free to, if you'd like to really dig into those details of how this is going to play out. Right. So in addition, when we're talking about footnote impact, in addition to those qualitative requirements and qualitative disclosures, the standard also entails numerous quantitative disclosure requirements. So among those, and a key point here, these disclosure requirements that you see that we'll outline here, there's a specific requirement that these amounts will be disclosed not on an aggregate basis, but that you will disclose distinctly the amounts that pertain to finance and operating lease. So you would disclose the amount for the finance leases, and then separately you would disclose the amount that specifically pertains to operating leases. So a key point there. So among the quantitative disclosures, you'll see lease costs. You must disclose lease costs segregated between those arising from lease asset amortization versus those pertaining to interest on your lease liabilities. Also, any types of non-cash investing and financing activities. So, if a company took use of an asset by way of entering into a lease agreement, that of course would be a non-cash investing financing activity. So, requirement to disclose those types of significant arrangements. As well as cash paid for amounts included in the measurement of lease liabilities. Right, and again, so we've included some illustrations for you to really dig into, which really show in practice how when you go about meeting those types of quantitative disclosures, how that will ultimately manifest itself on your footnotes in terms of how that will look to meet those requirements. Right. Also involved by way of quantitative disclosure is the requirement to separately schedule out your future finance and operating lease payments. So within this reconciliation, we'll see an example here in a moment. That reconciliation is specifically required to list the undiscounted cash flows, so the actual cash that's going to be going out the door. A company is going to have to disclose that on an annual basis for at least a minimum of each of the next 5 years, and then as well as a total for any remaining payments beyond 5 years, and then ultimately that listing, that schedule that you'll have to include in your footnotes, must also include a reconciliation back to the balance sheet to tie those things together, and we can see what that'll look like. An example of what that will ultimately look like in the footnotes. So again, key point, operating leases have their own column, financing leases have their own column, and really disclosing the cash flow impact. The future cash flow impact is a key part of the schedule for each of the next 5 years. And then just also then backing out by way of reconciliation on that second to last row, the amounts pertaining to interest, which ultimately then enables us to link back to the balance sheet and connect that schedule to what's on the balance sheet. So another key additional disclosure just to prepare and be mindful of and start to really set yourself up to be able to meet the requirement. Lastly, last thing that we just wanted to point out by way of disclosures. So we have some additional disclosures we just discussed that are going to have to happen every year under the new standard. But then in addition to that, in the year that company adopts this, there are also going to be certain specific things will need to be disclosed as well that just speak to important aspects of that transition. Things like what method of implementation you used, the impact on prior year information, because the prior year for comparative purposes does need to be recast for consistency. The cumulative effect on equity of the change to the new standard, and then also disclosing the use or lack thereof of those practical expedients that we talked about. What particular practical expedients the company used in the process of adopting the standard. And there's an example to reference for future of what that might look like, that transition disclosure. So with that brings us to our second polling question. And again, be sure to respond to this just to ensure that you get your CPE and get credit for that. Our second question is, what is your progress toward preparing for the new lease standard? A, still trying to understand the new standard. B, in the process of quantifying the impact. C, you already adopted the new standard and you're good to go. And D, there might be some that are hoping to retire before the implementation date of 2020.
I put D in there because I actually remember a couple years ago when the lease standard first came out, and a little bit before that, RevRec came out as well. I can think of one or two clients who half-jokingly said that they were hoping to retire before this came into effect, just so they could avoid the headache of implementing this standard and revenue recognition. Do we have the results on this polling question? All right, the results are in. The first answer was you're still trying to understand the new standard. So that was 46% of responders. The next one is they're in the process of quantifying the impact. That was 32%. And the next most popular one was hoping to retire before 2020. And lastly, we have 9% of responders who have already adopted the new standard.
I would also say, just seeing those results for the folks on the call, keep sending your questions in. We may not get to all the questions by the time the presentation's over, but love seeing the questions, because quite honestly, if you have a question, I'm sure there's probably about 10 other people on the call with a similar question. So by all means, send those in, and we like to take a look at them, even if it's just comments. Maybe for those already adopted, I'd love to hear some feedback on it.
All right, so we're now to the last section of the presentation. This is the more applicable section. What do I do now to prepare for this standard? So I broke this down into 3 different steps. The first step is to identify the contracts. So obviously, in order to identify the contract, you need to understand the standard's definition of what a lease is. As Tim and Dan already alluded to, the definition has not changed much from Topic 840, the existing leasing standard. But it's still a good idea for you to familiarize yourself with that new standard. Next, you're going to actually take an inventory of your leases. So I don't know how you are currently tracking your leases. You might have some in a spreadsheet, some written down somewhere, some just intuitively, but you're going to want to put all of those leases in one centralized location. So make sure you have a complete population of leases. You're going to want to talk to your management team, your other departments like accounts payable, IT, maybe maintenance, just to ensure that you don't miss any leases, as these are all going on your balance sheet. And obviously there will be some audit procedures around that population of leases as well. The next step is, once you've identified all of your leases and you have a good population of leases, you want to evaluate the impact. So quantify what those leases, how those leases will impact your financial statements. Understand the right of use asset, what that number will look like. Understand the breakout on your liabilities between current and non-current lease liabilities. And then once you can quantify it, you want to share that information with stakeholders. So I would start with your management team and with your board of directors. Make sure they understand this change is coming. You don't want them to be surprised once you implement this, but rather educate them now. So if you know that your management team or the board has certain ratios or financial numbers that they consider important, which will be impacted by this lease standard, you might want to consider for the first 2 or 3 meetings, maybe showing the new ratios alongside what those ratios would be excluding the lease standard. Again, just to educate them and hold them, or help them hold you accountable through this process. And you also want to share this with your bank. Make sure the bankers that you're working with understand this new standard and understand how the standard will impact your financial statements and debt covenants and ratios and things like that.
I think that last point is a key point, Brett. Talk to your bank. I don't think it's honestly too soon to talk to your bank as you're going through the process, even internally, just to get a feel for where your bank stands on all this, what they expect, what they're hearing in the industry. Last thing you want to do is surprise them. And I know we just got a question as well related to just that. So we have clients out there that prepare monthly and quarterly financial statements and basically asking what the expectation is for those. And I think that's going to be, my answer to that is that it's going to be a case-by-case scenario. So that's why that last point I think is very critical because while there may not be a ton of value gained internally with debt covenants and things like that, you want to make sure your bank is fully aware of at least preliminary estimates on how you think it's going to impact the financial statements and their expectations.
Yeah, that's a good point. And I would certainly encourage you to look over your agreements with a bank. And if you think there are any terms in there that might be ambiguous, reach out to your contact at the bank and try to define those terms now rather than later. Terms such as indebtedness, does that include lease liabilities or no? I think you can make a good case that it should not include lease liabilities, but ultimately that's the bank's decision. It could change from agreement to agreement. So you might as well reach out to them and make sure you guys are using the same terms or the same definitions of terms. And the last step, step 3, now that you've identified your leases, you've quantified the impact and understand how that will impact your financials, you want to develop processes going forward. You've spent all this time getting a good lease population, so you might as well put in the effort to ensure that you have a good population moving forward. So part of that is understanding who has access to enter into contracts, to enter into leases. You want to make sure that they're aware of how significant responsibility that is, so that when they enter into a new lease, they're updating that population of leases. You also may want to consider a transition team or implementation team. That might depend on how significant these leases are to your business. If you go down that road, I'd recommend at least involving departments such as accounting, IT. If you have in-house legal counsel, that they might be able to help you. Maybe your warehouse team. You want to get people from different divisions of the company to give insight into that implementation. And the last 2 bullet points there are just kind of some practical advice. If you're concerned about adding a liability to your balance sheet, you may want to consider entering into shorter lease terms. Obviously, the shorter the lease term, the less the liability going on your balance sheet. And lastly, it might be a good time to consider updating your capitalization policy. The reason being, you're about to add a lot of assets to your balance sheet. So whenever you determined your capitalization threshold, that was with an expectation of a smaller balance sheet. So as your balance sheet is growing, it might be a good time to reconsider, is that still the right capitalization policy, or do I need to change that threshold? So this survey is coming from Lease Accelerator. There were companies who responded to what the biggest problem of lease implementation was. And as you can see, the number 1 issue was collecting the data, which I put as step 1, creating that population of leases. So certainly if you have not done that yet, you can see people are considering that probably the hardest part of this lease standard is just getting a complete population of leases. So you should get started on that as soon as possible. And this brings us to the last polling question. Again, please make sure you're responding to this to get your CPE. The last polling question is, what tools do you anticipate using to account for leases going forward? A, you can modify your existing software. B, purchase new leasing software. C, utilize Excel. Or D, your leases will not be in a centralized location. Dan, I'm curious, what do you anticipate most of our clients selecting there? What do you think is the most common tool for companies we work with?
Based on most conversations I've had at this point, I fully expect Excel to be the most common. However, as companies start diving into this, may possibly realize they have a lot more leases than they anticipated, Excel may become cumbersome. So they may start evaluating specific software or outsourcing the calculations of the leases.
Okay. And do we have those results in? We're still waiting on that. We'll give you another couple seconds. All right, and it looks like about 2/3 of people responding are planning on utilizing Excel. So only 3% said that they aren't going to put their leases in a centralized location. Hopefully they don't have any leases or one lease, as that is probably not a good idea. All right, so we're going to move on then. We're wrapping up here. Regarding lease software, so this is a decision you have to consider, is this right for your company? Obviously, that's going to depend on the size of your company, the amount of leases you have entered into, the how significant leases are to your business, not only currently, but as you're looking down the road and continuing future growth. Do you expect leases to be a significant part of your business? If so, it might be a good time to invest in lease software. We put two specific options there, Lease Accelerator and Visual Lease. Those have just been passed along to us as good recommendations, although there are many others out there that you can look into if you go down that road. And then how can we help here at McConley and Asbury? We have a couple options there. First, we can provide outsourced accounting solutions for your leases. So that could involve helping obtain a population of your leases or reviewing lease agreements, or even helping with the accounting, helping with the journal entries regarding this lease standard. And another option would be to create some type of customized education for your organization, whether that's talking with you, or if you have a transition team, we can help meet with them. Another option here, Dan, we have is maybe we can help educate you on financial reporting framework for small and medium-sized entities. Why did we put that in here? Why do we think that could be an option for our clients to consider?
This is definitely an option that I think our typical client should consider. There is no threshold for small and medium-sized entities under this guidance. This is guidance put out by the AICPA, designed primarily for private companies, and it's basically an alternative framework other than GAAP. That, quite honestly, if you've sat through this presentation and you really want to retire and don't feel like going through this or revenue standard, moving to this framework would allow you to not have to go through the lease standard or revenue standard. Your financial statements would essentially stay intact as is. The report would look a little bit different from us, would not reference GAAP, but would reference this framework. But again, it's a great option. I'm pushing it to our clients where I think it makes sense. It's a great option that you want to get in front of your banks just like everything else. Make sure any users of your financial statements would be okay with that.
Great. So if there are any ways that we can be of help to you as you implement the standard, please let us know. You can reach out to us. We have our contact information at the last slide. And this is just a summary slide here proposing or showing the 3 steps that I outlined. Again, it's first identify the contracts, then evaluate the impact, and lastly, develop processes going forward. So here is our contact information. We're at the end of our presentation. I know some questions have come in, and we'll try to respond to those individuals after the webinar. But we just want to say thanks again for attending the webinar, and that is the end of our presentation.
Thank you once again for joining us for this webinar recap produced by McConley and Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting us online at macpas.com. Thanks again and have a great day.